So in this video, we're going to look at credit creation. In a modern economy, most money is created by banks through the creation of bank deposits. These perhaps are about 98% of money are bank deposits. There's two ways of looking at credit creation. We'll first of all look at a traditional textbook example of credit creation. And then secondly, we'll look at what actually happens with modern banking. So to start off with, let's assume we're on this beautiful orange desert island. On the desert island we have Laura. Laura arrives with £100 and she walks around the island and she comes across a bank. And in the bank she deposits £100. So the bank now has £100. Now, the bank thinks, we can use this £100 quite effectively and quite efficiently, because what we can do is we can maybe loan some of that out, because Laura is not going to take out all of that £100 at one time. You don't take all of your current account or savings account out at one point when you go to the cash machine. You might be take 10, 50, £100 out, but maybe not all that is in your current account. So the banks rely on that and say, to be prudent, they keep 10% back. So they keep £10 back, which means they can then loan out £90 to Will. And Will then transacts that to buy something from Bill, and then Bill puts that back into the bank, okay? So the bank now has a new deposit of £90. From that £90, the bank thinks, yes, we'll better be careful. Bill might take some cash out, so we'll keep 10% behind. So they keep £9 as cash and lend out £81. And say they lend that out to Sarah. There we are, here's Sarah looking happy and got her loan for £81. And then that, she maybe spends that, okay, and that ends up back in the bank. And you can see this process goes on and on and on. And you may notice it's a bit like the multiplier effect in the real economy. So what we have is the bank creating creating money based on deposits. And so you may notice, if we keep this process going, if we start off with an initial deposit of £100, we'll end up altogether with the creation of £1,000. Yeah? And that assumes we keep 10% back. So it assumes the reserve ratio, we keep a reserve of cash behind of 10%. As a decimal, that's 0.1. Now, what if the bank had to be more cautious and to be more careful? You might increase that reserve requirement to 20%. And if you were to do that, you start off with a £100 deposit on the island. You have the money multiplier process goes on and on and on, and then eventually you end up with £500. Okay. So, looking at this simple formula, which we can derive from this this explains this money multiplier process. Money multiplier equals 1 over reserve ratio. So the bigger the reserve ratio, okay, the less the money multiplier effect in an economy. And central banks require banks often to keep a percentage of their assets as a liquid reserve. Okay. And the bigger that liquid reserve means that banks are likely to be more stable, and it means that the money multiplier will be less. There'll be a lower money multiplier. So for example, if the reserve ratio is 0.5, we start with £100, we're going to end up altogether with £200. So a much reduced final credit creation process. So that's the traditional textbook version of credit creation, and this is the formula for the money multiplier. However, modern banks basically don't need the deposits. They just create credit by extending loans to businesses and households, individuals, whether it's loans to set up a new business or for a mortgage. And so they don't need the deposits and from savers in order to do this. So new loans, basically, when they're credited in someone's account electronically, they become new money. And so if you're answering a question as this, you've got quite a lot of marks, good to go through the credit creation process, but explain that this is how it tends to occur in the modern economy. The textbook example and what actually happens in the modern economy. Okay, thank you very much.